For centuries, merchant banking houses built generational wealth not by timing market hype, but by mastering the cost curve around physical commodities like oil, copper, and gold. And the new age, with electricity being the new commodity, they're running that playbook again. We're going to talk about how to run the playbook. Let's get into it. This episode is brought to you by Stonehill Wealth Management, where we help our clients invest money into the future. Alrighty, so I have been on this. Let me backtrack and give you kind of my thoughts, right? So like the present everyday media, like I go through periods of time where I get up to date. I don't watch the traditional media, right? I'm on like podcasts, nerding out on the front lines of how things are actually changing because I listen to like multiple podcasts around all the ideas that are important to get like the most objective truth for me, right? And what I'm looking at. And so like I go through periods where I get bored because it's just saying the same thing over and over again. And I can listen to like one or two podcasts a day to keep up to date. But for my extra media time, I like to go down rabbit holes. And so I've been on this rabbit hole of like merchant banking. Because in finance, how do you say it? And this is in every field, right? In every field, when you can go to the root of the field and then you can stay up to date on the present cutting edge of the field, you kind of have a whole picture because once you get a feel for the principles, you're just connecting the dots through time, right? So merchant banking is the roots for the entire financial system as we understand it. And the financial system when it's built on like rooted principles, not like distorted viewpoints from users or colonizers who bent the system to their will, right? So that's why I'm going through a lot of merchant banking because it's the roots. And in side note, and when you understand the roots too, you can understand where the colonizers took over and bent the flow to extract wealth for their fiefdoms. But going back to it, the core of a civilization of building wealth as a merchant banker is if you strip out the civilization, right? Because civilization is a shared understanding. Like for example, any moment in time, somebody can run a car into anybody walking down the street, but we don't. Why? Because we have a shared belief system of respect. Things that we use as money, they're not even real. They're like digits in an account, right? But why do we go to jail for not paying, digital, made up money, right? Why do we allow people to put us in debt and extract energy from us and take our property because of the shared belief system, right? So it's real and it's not real, right? And so what underpins and what's like, so when you're doing this as a money, you got to understand like what's most real, right? Because at the end of the day, the physical resources, labor, raw materials, that's what's real, right? We use money to coordinate using labor to turn natural resources into the things that we want, right? And then I won't go into the security around it and maintaining it, but at the core of a civilization, that's like your base raw material. Like that's the raw ingredients for a civilization today, a civilization 2,000 years from now, to civilization 2,000 years from now. It's the physical labor, the electricity that runs through our body that moves us to work, mental or physical, and it's the raw materials, right? If you strip it down, that's what it is. And so merchant bankers understood that, right? Because they weren't that fancy. They were pre-civilization, right? And during civilization, but I'm saying they are the ones that built civilization from a financial standpoint. And so what the playbook is when the prices of the raw materials are rock bottom, right? Or at the production cost, at the base cost, they accumulate. And then what they understand is, think of like liquidity. Liquidity is the equivalent of like belief. right? So, and what follows belief is credit, extending credit, like the fake money, right? Let's call it credit, the imaginary money, the civilization's money, right? So if you invest your resources into the raw materials at the base costs, the liquidity wave is going to come because humans going to keep dreaming, right? We're always going to dream. We're always going to want to build new shit, right? And we have to continue to build new shit to support civilization. If we don't, civilization dies. And civilization for humans haven't died yet, and it's never going to die, in my opinion, right? Unless we die, right? Which that can happen. But I'm saying as long as we can physically be here, civilization is going to keep expanding, right? So they understand that. So accumulate things at the production cost. Understand liquidity waves, right? That's understanding what banking system moves the most money around the world, what banking system moves the most money around your jurisdiction, right? What are those flows, right? This is what I do as a wealth manager all day, tracking flows. But these liquidity cycles happen in 5 or 7 year cycles. Think of them like rain cycles, right? So understand when the rain is coming. And as the liquidity cycle comes in, the rain, when rain hits the ground, it has the plants grow, right? They grow. If they're not there, summertime, we all looking at our yard right now, and it's turning a little bit brown, right? Same thing happens in money markets, right? So you understand it, ride the liquidity cycle, right? And then when it's harvest time, when it's fall time, you harvest, right? When it's fall time in the markets, time is like an example of fall time right now in the AI space is when you get SpaceX IPO and people who don't even understand AI, who don't understand the real bottlenecks, who don't understand energy is the bottleneck of AI, who are just living on the hype when they get in and they push the value of a company up so high to where it doesn't make financial mathematical sense. Separating the fact the company is a great company. SpaceX is a great company. It's going to be, the most valuable company again in the world at some point in the future, right? But I'm talking about today, right? We're in that greed part of the cycle, and you look around and you go, well, man, what's cheap right now? Energy companies, Bitcoin, we'll get into Bitcoin. Infrastructure assets, those are very cheap. Those are boring, but they're cheap. But the greed cycle is where we are in the AI. And by the way, like each industry has its own cycle, right? But what I'm saying is this is an example of where you ride the liquidity cycle and you sell out in the greed part of the cycle and you park your cash in short-term treasury bonds or cash until the market conditions match your strategy, right? But what the merchant bankers, they do that around energy, right? The raw inputs, right? So right now is when they are accumulating raw materials aggressively, right? I'm going to get into something before I get into the Q&A, but the traditional maybe hiccup in this model is technology naturally is deflationary or reduces cost on commodities over time, right? Because drilling machinery gets better. Now we have autonomous mining, right? The technology improves and it makes the cost of producing the units cheaper in gold terms, right? And this is why this is important. Even because somebody would say, well, man, the cost of raw materials in America have gone up every single year. It hasn't gone down. It's going down in dollar. It's going up in dollar terms. Dollar's not even real money. Remember, that's imaginary money, right? Gold is the money that you price things in if you're a merchant banking family, because gold is like the universal money. It worked 1,000 years ago, 5,000 years ago, because it's the toughest to mine. And in order to have, there's no more gold created. You got to have a star blow up around us to have more gold created, right? So the technology can get better over time, but technology around that gets better at like 2% a year, right? So I'm going into the weeds, but I'm just saying the cost of things in gold goes down over time with the technology, and that is why gold continues to be used. But again, what the technology class did to help improve money using merchant banker old school rules was they created Bitcoin, right? Because what Bitcoin does is it relies on specialized computers that burn electricity, right? A physical commodity, right? And this is the cool part about electricity. We used to read, they invented electricity. No, like electricity runs through our body. It's always been a staple in the universe. We just like learned how to harness it, right? In the last 100-year century, right? So now this century, we're saying, all right, we know how to harness it. Every country that is wealthy harnessed electricity in the modern age. The plug-in to electricity is natural resources, oil, gas, coal, wind power, solar power. Like you can generate a lot of different ways, but it's like the raw energy of the universe that we learn to harness. And so Bitcoin creates specialized computers that burn electricity to solve puzzles and issue new coins, but the coins are limited. It's only going to be 21 million, right? And unlike crude oil in the ground or gold in the mountains, there's no physical commodity to dig out the dirt, right? The software strictly controls the release schedule, no matter how many extra rigs get turned on, right? And that's really important because Bitcoin anchors its money creation directly to kilowatt hours of electrical energy and silicon hardware, right? Silicon being a natural resources. Follow me, y'all. Explain Bitcoin and why it's so valuable. And I'm explaining it's anchored to physical things. Because side note, the commodities markets wouldn't work without electronic trading systems. You know what I'm saying? Like people go, oh yeah, copper, oil, silver is worth this much. Well, it wouldn't be worth as much if you didn't have an electronic trading system trade on top of it, because the prices would be all disjointed and non-local because of different prices everywhere. So again, this is an upgrade, but now we're using electricity and silicon and computers to run the system. But unlike gold and oil, the technology process cannot flood the market with extra units, right? Which is what you can do with commodities. You can get better at extracting gold from the ground. You can get better at and speed up the process of it coming out. You can get better at breeding cows. You know what I'm saying? You can get better at, producing oil and finding it in different places. And so in Bitcoin, right, when chip efficiency improves, again, the silicon, Bitcoin software automatically raises the mining difficulty to maintain the issuance rate. And I won't go into the nerd story around it, but every 4 years on schedule in the software, right? Every 4 years on schedule, the halving process cuts unit issuance in half, right? Which doubles the amount of physical energy required to produce a single Bitcoin. Even if with the other commodities, as we get better technology, it drives down the cost in gold terms, right? With Bitcoin in the money system, in the software system that runs the money, as technology increases, it just adds to the security because the difficulty raises every 4 years. So as technology gets better, the difficulty adjustment raises every 4 years on schedule, which means that extra computing power that we gave to it just adds to the security of Bitcoin. So I'm explaining the mechanics, y'all. Like, this doesn't mean the price of Bitcoin is guaranteed to go up every single year, right? What I'm saying is structurally, it's designed to put a floor on the physical energy required to maintain the network, which is like an amazing money system from a design standpoint. If there's no flaw in the software in the future, which that's a big risk, right? This floor is going to continue to suck more energy into the network and create that floor. And that's what you want for money. Again, think of money like a person, right? If a person continues to bring in energy and they can hold it, they're going to get more and more and more powerful, right? More and more and more powerful. They keep bringing in energy, they can hold it, they get more and more and more powerful. Versus what I'm saying with the commodity markets and every other money, as technology improves, it leaks some of that energy from the commodity, right? So the software system said, we're going to build it to where this thing is capped so it has a solid body, right? And as more energy is added to the network, we're going to we're going to, how do you say it, increase the gravity? Here's a good way to explain it. One of the things that people, middle-class families and classes with a lot of money worry about is, how do I bring in energy? How do I get rich? How do I get more money and not spoil my kids? Right? Like, that's the balance. Like, how do I bring in energy and not spoil my kids? What Bitcoin says is, listen, we're going to bring in, by the design, like, we're going to make it to where we can bring in an unlimited amount of energy, right? Because we know that the world's going to continue to produce fake money, credit, to support the economy, and Bitcoin is capped, right? So what that means in thermodynamic energy terms is that's like the definition of infinite, hard cap, unlimited money. So then you go, and what we're going to do is, in order to make sure your kids don't get spoiled, we're going to make that shit harder and harder the more energy goes into the network for the people that are providing security to the network, right? I'm translating that to kids. It just means, even though you're rich, we're going to set it up to where life is going to stay a challenge for your kids. You know what I mean? And so that's an amazing design for money, because spoilage leads to the price crashing relative to gold over time. That's what spoilage is, right? And it's natural, right? Because spoiled kids are weak. And so, like, that game is up and it's rigged. Anyway, I digress. All right, let's go to Q&A. Question number 1. Historically, how did classical merchant bankers determine the bare minimum cost of production for physical commodities like oil or gold? And how does an investor pinpoint the same energy floor for Bitcoin today? All right, traditional commodities bottom out at like the raw extraction cost, right? Like fuel plus machinery and labor, right? Below that price, I mean, you can't run a business without positive cash flow. So the drillers turn off, pumps and supply dries up, right? So that's physical commodities work that way. For Bitcoin's floor, it's calculated by mostly like the electricity cost, right? They have the labor production cost, but the majority of a Bitcoin miner's floor is electricity cost for the most part, right? And so when the price equals the electricity costs, all the speculative hype has been wiped out and you're buying like pure value, right? So right now I'm like gonna overestimate this, so don't quote me, but we're really pretty close to the pure electricity cost of Bitcoin at the current moment for miners, right? So it's extremely cheap from a commodity standpoint, right? So this is where, in the beginning, I was saying AI, everybody chasing the AI things is fine. In a commodity cycle, like, it's relatively cheap. And this is when, if you're a merchant banker and you're buying commodities, right? Whatever, it doesn't matter what you're buying. You want to buy cheap and sell high, right? So this is independent of emotions, right? So that's what's happening, right? So, but I want to give like the disclaimer, right? Putting money into digital asset strategies is a high risk business, and it's not for everybody, because you got wild upswings, government regulations, power grid restrictions, blah, blah, blah. But everything is a risk. I'm just explaining the cycle. Question number 2. Why does technological innovation drag down the long-term price floor of traditional commodities like crude oil or copper, while making Bitcoin's production floor get higher over time? So commodities, right, drive down costs because better tech, right? Think of like fracking, what fracking did to oil and gas, automation, right? When you got cheaper extraction, markets flooded with extra supply, right? Supply and demand curve, right? When the supply increases relative to demand, the price drops, right? Natural, easy economics. Bitcoin with better tech, which is like faster mining chips, the software that's programmed into it, the difficulty adjusts upwards, right? So in short terms, that just means, cool, even though technology is better, you can't get more Bitcoin per mining period. That's set in stone. You do got to buy more power though, but that power is going to go to secure the network more, which is why when you look at everything, Bitcoin, it's more and more energy added to the security of the network. Somebody was saying, yeah, but what about this recent hack that's drained all this Bitcoin from wallets? Yeah, that was a wallet hack. That wasn't the Bitcoin network, right? That's a wallet hack, different than a Bitcoin network. So technological progress doesn't create extra coins, right? The software converts that energy efficiency directly into network security. Again, Bitcoins. When you like nerd out on like cybersecurity and money, you get to the point where you go, damn, like this is like some super secure money, right? Question number 3. What physically happens on the energy grid when Bitcoin's market price drops below the electricity cost to mine it, and how does the network automatically fix itself without a central bank? So when prices drop below power costs, high-cost miners turn off machines to halt losses, and the global hash rate, which is like the energy contributed to the network, falls, right? Fewer machines, slow block times down, difficulty adjustment lowers, right? So it goes in reverse, right? It lowers down the difficulty adjustment to make it easier to mine, to incentivize people to put energy back in the network, but because the production cost has to drop to meet the market price and stop the crash, right? It's supply and demand. It's like the equivalent of governments right now. Everybody needs money, so people are raising rates to bring in money internally to support the asset prices of their system, right? Bitcoin just does this internally in their software, and I'm always working to explain this stuff more simply. But again, the point I'm trying to communicate is like one core thing I think everybody wants to do when they want to study money is understand supply and demand at like its basic level, right? If you want to understand money for real, understand supply and demand at its basic level, and then you can understand any financial system, because this is what I'm explaining. Question number 4. If microchips keep getting more energy efficient every year, why doesn't that make Bitcoin cheaper to produce in the long run? Every 210,000 blocks, coin issuance cuts in half, right? Overnight, it takes twice as much physical production to produce one Bitcoin, right? So let's say annual chip efficiency gains are like 15 to 20%. I'm just picking this number out. It gets completely overwhelmed by a 50% supply cut, right? All those gains get eaten up by the supply cut. And that extra energy given, again, goes to support the network. And that program supply cut turns what would have been a flat commodity cost curve into a floor that steps upward every 4 years, right? Just a stair step, right? The family gets richer, but the kid's life stays where they have to still put in energy and effort and contribute their energy to society so they don't atrophy, right? Here's an even better analogy, like I'm trying to make sure I protect the innocent. So I got a friend who's divorced, and during COVID, his ex-wife got super nervous about everything, right? Because during COVID, just everybody was nervous, right? It became and then you were online, and it became like a nervous loop. And so, some people moved towards internal healing, right, and got off online. Some people got in that doom loop, right? But the doom loop began to affect how she parented the kids, because then she wanted to protect the kids from everything. I digress. Next question. How does a modern institutional treasury or macro investor actually execute this commodity strategy using Bitcoin, cash, and short-term debt across a 4-year market cycle? Alrighty, this is what I like. This is what I love looking at, right? So you understand the production cost of Bitcoin, and you buy when it's relatively cheaply, i.e., it's not a recommendation. I'm saying right now it's very cheaply. And then when you check the temperature, everybody's super fearful, right? And so you go, dang, man, this is a phenomenal. Blood is in the streets. The commodity price is cheap. The network is still strong and secure. All the financial institutions are lining up Bitcoin buying programs. The governments are making it legal tender all around the world. You're going, man, like the only people who are not buying Bitcoin are people that can't handle their liquor. You get what I'm saying? They can't handle their emotions. And then you sell inventory into central bank credit expansions, right? And retail bull manias. So you rotate and when you do that, you rotate your profits into short-term treasuries or cash, right? So you ride the cycle, because there's going to be a time in 1 year, 2 year, 3 year, 4 year, 5 years where everybody's going, Bitcoin's going to 4 million, when it's sitting at whatever, close to $1 million, they're going to be like, oh, yeah, YOLO, blah, blah. And you're like, just selling your Bitcoin into it, putting your money in treasuries, just watching, letting the media rile everybody up, right? And then you sit there patiently and you wait for the speculative leverage because, right, when they're doing that, everybody's borrowing irresponsibly to buy Bitcoin, which was pushing the price up beyond natural levels, right? So you patiently wait for the speculative leverage to wipe them out, and then you re-enter when it's cheap again, which should be structurally higher than the last run up because of the difficulty adjustment, right? So that's why you see every 4 years, the bottom of Bitcoin stair steps because of that difficulty adjustment, right? So this is what I'm saying. It's like, merchant bankers, it's no different than selling t-shirts, than selling properties, than selling CDs. You know what I'm saying? You buy cheap and you sell high, and you just run an inventory book, right? Merchant bankers run an inventory book with money, right? And all money has a commodity base. You know what I mean? And so if you understand the commodity base of the new money, like we can run this trick every 4-year cycle. I'm 42, right? So I'm looking forward to running this playbook for 50 and 60 years, right? So I got 10-ish cycles, right? Which is exciting. And there's a lot of money you can make by running this cycle because Bitcoin, electricity is a real commodity that ain't going nowhere. And we wrap that commodity around a financial system that is independent of government stupidity and theft, and that all the governments know they need. It's like electricity. They incorporated electricity into their civilization because it was better. They're not going to get rid of Bitcoin, and they're not going to get rid of electricity. In my opinion, it's here to stay. So now you just got to trade the cycle, right? So hope this helps. Make sure you like, subscribe, hit the notification button. If you're watching on YouTube, be fruitful and go multiply your money. Killed it!
Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.